I am so glad you convinced me that the family car should be the Defender 110. It is so beautiful inside, it's so comfortable, and it just feels indestructible.
Yes, it really is. I've been waiting a long time for the new model to come out. The Defender 110, I'm telling you, it's my favorite car of all times. It's my third one. You know, I have stories of going off road. The guy managed the group. He was like, "What are you doing in this beautiful car?" I'm like, "I'm going off road." He's like, "Are you sure? Because you can use one of ours." And then they look like Mad Max cars. I'm like, "No, no, 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 we're going to do this." And he was shocked.
Wow. Well, it's great because the Defender has been reimagined for 21st century adventure, and its unparalleled off road ability, as well as its robust interior, are invaluable whether you're headed towards uncharted territory or just a weekend of exploration. The Defender 110 tackles challenging surroundings with absolute confidence. The SUV conveys strength outside and in, featuring peerless technology like an intuitive driver display and an award-winning infotainment system. That's my favorite part, to keep you connected no matter where the journey takes you. Adventure is unique to everyone, and so is the Defender. Choose from the two-door Defender 90, the four-door Defender 110, or the larger Defender 130 with the ability to seat up to 8 passengers. You'll find uncompromising performance in all three. So pack up and go even further with the Defender 110. Learn more at LandRoverUSA.com/Defender.
These days, we're all investors, trying to be smart with our money despite our worst impulses. But at iShares, we believe that deep down inside of every investor is a better investor. One that's just waiting to be let out. Explore iShares ETFs and insights and let your best investor out. Visit iShares.com for more information.
This isn't your average business podcast, and he's not your average host. This is the James Altucher Show.
So, Omid, I don't know if you know Cal Fussman. He was an editor at large at Esquire. He interviewed everybody from Gorbachev to, I always think of Gorbachev, but everybody on down from Gorbachev. And Larry King and Cal had breakfast every morning for like 700 years. So he's the interviewer's interviewer and super smart guy. And Cal Omid has written books about crypto. He was really responsible for crypto at Citigroup, like was one of the top guys for helping Citigroup figure out the crypto landscape. And Omid and I have worked together since 2002, Omid, or 2003.
Yeah, sounds about right. And pleasure to meet you, Cal.
And it's great to be here. Thank you. I just thought I was going to be a fly on the wall, but I'm so grateful to be able to participate. But I'm going to be listening for a while because I got to get caught up on stuff.
Yeah, no, Omid, I was thinking I would give like a brief explanation from the banking viewpoint of what has happened recently, just like in layman's basic terms, because I think the media is fanning a lot of different flames, and I just want to put it in perspective. And then I would love then to hear and maybe even challenge your perspective from a crypto viewpoint.
Sounds perfect. Let's do it.
And Cal, when I describe the bank stuff, feel free if you have any questions. I'm just going to go really 10,000 feet high at first, and then we'll see, where it lands. But we all have been seeing the news. I just saw two headlines back to back this morning. Banking system could collapse within the next 24 hours. And the other headline was, everything's fine, don't worry. And so the truth is, A, nobody knows, and B, the answer is probably somewhere in the middle. But to understand why, it's important to know what the basic business model is of a bank. People give money to a bank. When you put money in a savings account, you get, the bank's obligation is to maybe pay you 1% interest per year. Then the way banks make money is they take all of that money and they lend it out, or they buy treasury bills that give them 3% a year. And they give you your 1%, they make 3%, and their profit is the 2% in the middle. I'm oversimplifying, but that's it. So they're buying treasury bills all day long, all year long. The problem is the treasury bills they bought last year are crap right now because the Federal Reserve has raised interest rates at the fastest rate in history. So if you are sitting on treasury bills that have a 3% dividend or a 3% yield, why would I buy one of those when I could buy new treasury bills that are yielding 5 or 6% because of rising interest rates? So, in a sense, what's happened is when there's a run on the banks, meaning more than 5% of the bank's depositors want their money back, the bank has to start selling these treasury bills at a significant loss. Because again, remember, the treasury bills they bought last year are worth a lot less than they were a year ago because nobody wants to buy those treasury bills unless you give them a deal. So the banks are losing money on every treasury bill they've bought until the past month or so because all those treasury bills are losing money. That wouldn't be a problem normally because eventually the treasury bills will pay all of their money over time with interest. Like the US government is a safe entity to lend to, which is what a treasury bill is a loan to the US government. So in the long run, all these treasury bills are fine, but short term, they're all losing money. So when there's a run on the bank, again, more than a few percentage of depositors want their money back is equivalent to a run. The banks have to start losing money by selling treasury bills at a loss. And so that's, in a sense, what is happening. There is a lot of people, depositors who want money back from, let's say, Signature Bank, which is one of the banks in trouble. Signature Bank doesn't have the cash on hand because they invest all their money in super safe treasury bills. So they have to start selling these treasury bills. They have to admit that they're losing money doing it, and then they actually run out of money and they go under. This is a little different than 2008 because banks then were buying super risky things, not super safe treasury bills. They were buying credit default swaps on mortgage-backed securities and whatever. But that's, in a sense, what's happening. It's all, a lot of it is psychology. If there's no run on the banks, there's no problem. It's the run on the banks combined with the Federal Reserve. They hiked interest rates so fast you couldn't adjust for the risk. Nobody could anticipate how fast they were going to raise interest rates. And this is what's causing the problems with the banks. And if everybody believes that all the banks are bankrupt, there'll be a huge run and then the banks will be bankrupt. If everybody believes that it's safe, there won't be a run and then everything's safe. On paper, all the banks are probably bankrupt right now because of the Federal Reserve situation. So that's the short-term summary, overly simplified, of what's happening. Like, Omid, would you add anything to that? Like, I've left out the crypto angle because there is an important crypto angle.
The only thing I would add is that this particular problem impacts small regional banks a lot more than the big systemic so-called too big to fail banks, because those banks have very large and very diversified balance sheets. Plus, a lot of their depositors tend to be more sticky, in part because the second we designate a bank as too big to fail, you don't worry about a run, because in the case of a run, everybody expects and has expected since 2008 that the government would intervene and bail them out. So the problem here in the US has been that small and regional banks, which are perhaps not too big to fail, but still had significant deposits over the FDIC insurance limit, are the ones that have experienced runs. But as we've learned before, once a crisis starts, who knows where it'll spread. So as of this weekend, what began as a regional banking crisis in the US has now taken out effectively one of the world's biggest banks, which is that as of this weekend, the Swiss government engineered a shotgun wedding where UBS bought Credit Suisse.
Yeah, for $3 billion, which is similar to when, like in 2007, when JP Morgan, or early 2008, when JP Morgan bought out Bear Stearns for $1, and there was arranged weddings back then as well, and that was considered the canary in the coal mine, which led to later Lehman Brothers. There's some history there too, though, where like when long-term capital was blowing up in the 90s, all the banks got together to bail long-term capital out, except for Lehman Brothers and Bear Stearns, the only two banks that were not bailed out in 2008. So Wall Street had its revenge. And so the crypto angle here is Wall Street and the government aiming at crypto-friendly and VC-friendly banks the way they aimed at Bear Stearns and Lehman Brothers.
In a way, yes. And I think this is going to, in time, turn into a scandal. or at least it should, because, well, first I want to acknowledge all financial crises are always multivariate. There's never one specific cause, right? Like even in 2008, yes, the housing bubble and the banks doing too much risky lending was one factor, but there were multiple factors. And this current bank run that we have, you laid it out well, James. Part of the problem is that banks bought a bunch of treasuries last year that are now trading down. But the multivariate part is also that all of these banks had an explosion in deposits during COVID because the Federal Reserve printed a lot of money while simultaneously trying to suppress interest rates. So all of these small and regional banks saw their deposits swell. And what banks do is they invest deposits in things like treasuries, but then they were forced to buy treasuries. Not forced, but they chose to buy the only treasuries available were the ones that paid extremely low interest rates. And then when the Fed started raising interest rates, then the assets out of their balance sheet fell in value. So now the crypto part.
Oh, no, let me just quickly add to what you said. A lot of banks are being accused now of not having appropriate risk management, but I just don't believe that's true because you couldn't, banks try to hedge their risk a little bit, but you couldn't have anticipated the speed with which the Fed would raise interest rates. So if you thought you hedged your T bills at 2% when interest rates were 3%, well, what happens now when they're 4%? Now your hedges are losing money and your treasury bills are losing money. So the thing about hedging is you're taking on twice the risk for half the money, and it really is twice the risk.
I think that's fair. Even I believe people have pointed out how even the Fed's own so-called dot plot, where they project their own future actions, did not anticipate the extent to which they ended up raising rates in the past 12 months. Although I wouldn't fully let bank risk managers off the hook either. At the end of the day, if you are going to be a private entity that is taking risks with people's deposits, you bear some responsibility for all potential outcomes, however unlikely they might be.
But I would say, like with Silicon Valley Bank, and this is an interesting point. This is the multivariate part. On the one hand, we could say it was targeted because Wall Street doesn't like venture capital and crypto. But the one place where Silicon Valley Bank didn't take appropriate risk management was they have a very unique set of depositors, like large venture capitalists who themselves, like if a few of them withdraw money at the same time, then Silicon Valley Bank's in trouble. They're not as diversified in their depositor base like a small regional bank might be, who has mom and pop banks at the small regional bank and big venture capitalists that have been slowly pulling their money out of Silicon Valley Bank for the past few months. They knew all along there was problems and there was this sort of risk, and Silicon Valley Bank did not account for that risk as well as they could have.
And this is one of the important lessons of history about the need to diversify a bank's client base. And it's a particularly American problem, James, because in America, for various reasons, we happen to have thousands of small banks. In contrast to Europe or even Canada, where there tends to be fewer larger banks, which there are downsides to that. But one of the upsides is that the banks have more diversified deposit bases. So in the case of Silicon Valley Bank for tech in general, but also the crypto friendly banks, which was this for a bank like Silvergate, this was even more true. The risk of having a concentration of deposits from one industry is that the health and soundness of your bank is now tied to the health and soundness of a single industry.
Yeah. So, and one final question about just on the banking side. The problem with this model, as opposed to 2008, where the securities that the banks owned were actually very risky assets, like triple mortgage-backed securities. But with treasury bills, there actually really in the long term is no risk. You're going to get all of your money back. 100% chance you're going to get all of your money back with interest, just not as high interest as the interest rates are. But if people just wait, you're going to get your money back. But the problem with the bank is if a depositor wants their money back, you have to give them their money back that second or day. So here's the question I have. If I were the Federal Reserve and there was a run on a bank, I would simply loan the bank full value of the treasury bills they own. And also I would get equity in the bank, just like in 2009 They took some equity, and the deal is I'm going to sell off the equity when it's at a profit, and so I don't nationalize the banks. But that seems like a good backstop just against treasury bills. So this way, banks are encouraged to buy treasury bills, and they know they have a loan for the full, because the loans are totally 100% safe. They know they have a loan available to them if there's a run on the banks. But there's a cost, there's a consequence. The Federal Reserve gets equity. The U.S. government gets equity in the bank.
So the first half of that equation is already true. That last Sunday, the Federal Reserve did announce a new facility that does exactly that. It allows banks to go and borrow against their treasury and potentially agency securities at par, as
Right.
if they're still trading at 100 cents on the dollar. Perhaps not surprisingly, though, the Federal Reserve is not taking any equity or warrants to benefit from the upside of this, or for taxpayers to benefit on the upside of this. And this leads to this whole other conversation as to what do we achieve when we just go from one bank bailout program to another, however justified they might be.
Which is why I think there needs to be consequences, and the U.S. government needs to benefit, or else we start to veer into nationalizing banks and fascism, where business and government are combined, which really is the definition of fascism, by the way, as opposed to whatever everybody thinks about fascism. So I think that part of the equation is important. But you're right; they are opening up the lending window to lending at par, which, by the way, prevents the a run on all the banks like everyone is afraid of. Like this is not as bad as 2008. Like, this situation is already resolving itself, although correctly, people are nervous.
That's correct. And I never thought it was going to be as bad as 2008, because in some ways we've been on this road for decades, where in the United States and frankly most of the developed world, we just don't let banks fail anymore. And we certainly don't let depositors lose money anymore.
And correctly so, because it's the government's fault the banks are so underwater on their treasury bills. Like, why is the Federal Reserve? I mean, basically every bank this second is technically bankrupt on paper if there was a run, because of the Federal Reserve raising rates so fast. So they got what they wanted. We have a potentially systemic crisis if people's psychology turns that way.
Yeah, I mean, the Fed certainly deserves a lot of blame, not just for raising interest rates as rapidly as they did, but for suppressing interest rates for the many years that they did, forcing banks, even the banks that wanted to be conservative a year or two ago, like there are a few things more conservative, as you pointed out earlier, as US Treasuries, but it just so happened that US Treasuries paid almost no interest a few years ago, even if you went out the yield curve to 10 and 30-year bonds. So this blatant suppression of what has been the normal financial situation for, frankly, most of history, which is that there's such a thing as an interest rate. And then short-term interest rates might be 1% and 2%, long-term interest rate might have been 5% and 6%. The Fed and other central banks collapsed that, which put a lot of these banks in a precarious situation, particularly during COVID, when their deposits swelled and they had no choice but to park that money in low yielding bonds.
Well, it's interesting. When on the podcast, I had a deputy Fed of the Federal Reserve on the podcast. It's Square co-founder Jim McKelvey is the deputy Fed president, Fed governor of St. Louis. He said the main thing they were worried about then was deflation. Everything was deflating, and so they were begging to have inflation. And now they got their wish, unfortunately.
They did. And then when the inflation showed up, they told us it was transitory. So they didn't act as early as they could have. I mean, there was a period not that long ago when we had GDP growing at a record pace because we were rebounding from the collapse of 2020. We had the stock market surging to all-time highs. We had unemployment extremely low. And at that very moment, we also had zero interest rates.
Yeah.
So maybe if the Fed had not injected as much liquidity as they did in the first place, or started pulling it out a lot sooner, this whole process of renormalization of interest rates could have happened more slowly, which would have given these banks more time to adjust.
But don't you think the Fed, like, the interest rates take about 12 to 18 months to really be felt in the economy? Everything else is anticipation. And we haven't had that. We're 12 months in now, a little bit more than that. But shouldn't they wait a little bit at some point to actually see the real effect as opposed to the psychological effect?
I think they should be more humble and stop thinking that they know what they're doing, because the history of modern central banking and these constant whipsaws just shows that they don't know what they're doing. And that's not because of the quality of the people, right? Like you could put the smartest people on the planet in the central bank, but ultimately the economy is extremely complex, and the forces that impact growth and employment and inflation are also very complex. And this idea that we have these group of like a dozen or so people that get together and say, well, we're going to do this, right? QE, raise interest rates, cut interest rates, et cetera. And because of that, here's our 10-year forecast of what's going to happen with growth and inflation, which, by the way, we've never been right once on any of this, but we're just going to keep doing it. And with every passing crisis, we're going to do it with more money than we've ever done before.
Yeah. Which, by the way, over the weekend, I think Balaji Srinivasan, a Silicon Valley guy, made a $2 million bet that within 90 days, the whole system collapses and Bitcoin will be $1 million.
Yeah, I disagree.
Yeah, I do too, because I think, and this is a very Silicon Valley perspective. A, crypto is not ready, and we could talk about that. But B, it's just not going to happen because there's not going to be a massive run on the banks like there potentially was in 2008.
No, because what we now know is that there is no level of government intervention that they won't do to preserve the banking system.
Yeah,
So
and they'll do it
the
fast.
downside, right? So the downside is not a potential complete collapse of the banking system. Certainly, if that didn't happen in 2008, it's not going to happen today when the big banks, like the JP Morgans of the world, are actually fine. They're very well capitalized and they have diverse balance sheets, and they've been experiencing deposit inflows as people leave these regional banks. So I think the real downside risk here is persistent inflation that the Fed can no longer fight, because doing so means breaking the banking system.
Oh my gosh, I love these clothes. Mizzen and Main. That's Mizzen and Main. It really is the most comfortable work clothes. Travel clothes. I had to travel this whole week. I'm traveling for a week and a half, and I just took Mizzen and Main clothes with me. Close out 2023 in style with comfortable, breathable, packable, and machine washable pieces from Mizzen and Main. As you wrap up your year-end goals, enjoy a Mizzen and Main dress shirt that you can wear confidently. I like that they've very, very just nice, solid colors. I don't really like to get all fancy in patterns and everything, although they do have some pattern shirts, but very comfortable clothes, stretchable pants. It's just super comfortable, but they look professional, and you can wear them casually or professionally. I like some of their flannel shirts or untuck shirts. I love untuck. I never tuck in. So again, whether you're shopping for a special someone or giving yourself the gift you really want, I just buy myself gifts. Mizzen and Main is the perfect gift for any guy who works, travels, and or cares about looking and feeling great. As you could tell by my many photos across the internet, I care about looking fantastic. I'm practically a model. And let's be honest, every guy loves to look great. So again, shop now at mizzenandmain.com and save 20% when you spend $130 or more using promo code James. That's promo code James at Mizzen and Main, Mizzen and Main.com. You know what I love about fantasy sports is that even though I'm not going to be a great basketball player or a baseball player or a football player or whatever, I feel like I get to participate and make decisions and use my knowledge of these different leagues or these different sports to compete. So it's like I can pick my team or I can pick my favorite players and I could use my knowledge to make predictions and maybe even make money. So with the basketball season here, you can now pick combo projections across football and basketball from the Specials League on Prize Picks. This is a league created specifically for combo projections that include two or more players from different sports or leagues. Want to play alongside some of Prize Picks' favorite players like rapper Meek Mill and comedian Andrew Schultz, who's also been a guest on this podcast, and I've been a guest on his? You can now find community plays under the promos tab of the app to view entries for some of the biggest names in the Prize Picks community each week. Look, Prize Picks even offers a reboot policy so that your entries stay in play even if one of your players gets injured. For football and basketball games, if you have a player who exits the game in the first half and does not return in the second, that player is rebooted. Prize Picks is the only daily fantasy sports platform with an injury insurance policy. What? So I love playing it. I love anywhere where I can use analytical ability with my interests to demonstrate some skill and maybe make some money. And I like the game like aspect. I do wish they had chess as a category on prizepicks.com, but I'll settle for what they've got. Maybe I should make my own fantasy chess league. But in any case, I love Prize Picks. Go to prizepicks.com/James. Use code James for a first deposit match up to $100. That's the easiest $100 you're ever going to make. So that's prizepicks.com/James and use code James. Daily fantasy sports made easy. Let me ask you this. I mean, Milton Friedman's statement, Nobel Prize winning economist, from from the Reagan era in the 1970s, Milton Friedman stated that inflation is always and only a monetary supply issue. So when the amount of money in the economy goes up, there's inflation. When it goes down, there's deflation. But we have seen, because of the economy shutdown, that there is such a thing as transitory inflation. Like when you stop cutting lumber for 2 years, the cost of building a house goes up because there's no lumber around. So that's an example of transitory inflation. When there's no supply chains working from China because China's shut down, price of pharmaceuticals and other things we get and computers go up because that's what we get from China. So, and when there's a war in Ukraine, the price of wheat goes up. So these are all transitory issues.
Yeah, sure. But at the same time, during COVID, the Federal Reserve expanded its balance sheet by something like $4 trillion, as did every other central bank in the world. And they started shrinking it in the past year. But guess what? Just by taking back a fraction of the amount of money that they injected into the system, the banking system started to break. So, literally, as of last week, the Federal Reserve's balance sheet has started expanding again because these new bank facilities, including the one that you outlined about lending against par, so far, I think the numbers are something like $200 billion in additional monetary expansion from the Fed.
Right. And so this is where it's scary. This is the scary thing that has to be underlined, is that now it's all psychology after that. Because every dollar that's printed theoretically changes the value of the dollar bill crumpled up in your pocket. And it's a story then. You have to either ask yourself, is the US economy thriving and innovative enough to grow faster than the devaluation of my dollar? Or is it weakening in some way? And whatever story you tell yourself is, and if enough people tell themselves that story, that's what's going to decide psychologically will the banks collapse or not.
Yes, but not again. Like I don't think that psychologically, it's not that will the banks collapse. I think just psychologically, are we just going to have persistent inflation? Because if this idea starts to set in that one, the economy cannot function effectively without easy money, which I think is true now, and two, that with every passing crisis, the government will go more and more out of its way to prevent a reset, which even something like saving these regional banks by letting them go and borrow against their underwater securities at par, or what some of the banks are asking for, which is they just want the government to guarantee all deposits for a couple of years, right? Individually, we can say, well, those are good programs because we don't want a collapse of our banking system today. And that's fair. But if you project forward long term, just like in 2008 or 2001 or 1998, there should have been a natural shrinking of the money supply because people and banks blow up. But the government is preventing it from happening. And I think at a certain point, psychologically, the message that that sends to everybody is like, hey, this Milton Friedman-esque money supply thing, it's only ever going to go in one direction.
Yeah, but again, as you pointed out earlier, it's not the depositor's fault. They don't know how to manage the risk that, oh, Signature Bank is not as safe as Wells Fargo Bank. Maybe it is, maybe it isn't. And I mean, big banks could blow up as well. It's really the bank's management who's at fault. And they do have real consequences. Like they will get fired if they have to go to the Fed. Management is taken out as first thing. So I feel like they do have enough consequences there at
Some
least.
of them, I mean, sure, like the management of the banks that have failed, which so far we should remember is really just three. It's Silvergate Bank, Silicon Valley Bank, and Signature Bank. Yes, that
First Republic
management.
also. I mean, they got taken over, but they essentially failed.
They're still operating, and the government has not taken receivership of them. So I don't put them in that category. But even then, sure, their stock has fallen. Yes, their management has paid a price. And I say this because other people are out saying, look, these bailouts are not like the 2008 bailouts because we didn't save the shareholders of these companies, which is true. All of their equity was wiped out. A management is often a major shareholder. That's true enough. But when you introduce the programs that have been introduced in the last week, you are indirectly saving the management of every other bank because all of their stocks, if the government did nothing and we did have a systemic run on all the small and regional banks, all of their shareholders would be wiped out. So by introducing these programs, we're sort of saving them and we're sort of saving their management. And again, like I have nothing against these people. You know, I'm not someone who thinks that businesses should fail and we should have banking crisis, but we should zoom out and be mindful of the overall trend, which is that in the developed world, we no longer let banks fail to the extent that their depositors feel the pain. So the question I ask you, James, and I ask everybody else is, if the government is always going to underwrite the downside of banking, isn't it a little bit of a farce to then say we have a private banking system where shareholders and management could benefit from the upside of banking?
The answer is nobody knows, right? It seems scary either way. If you don't do what the Fed's doing, then a lot of poor, innocent people are going to lose their life savings. And that's horrific. And by a lot, I mean tens of millions. And if you do this, you have the consequences you're saying, which is that at some point, the easy money gets a little too easy. And then the story becomes true that the dollar becomes weaker and weaker and weaker, and inflation turns into hyperinflation. So that's the bet Balaji Srinivasan made over this weekend, is that he thinks that time is now. By the way, on my podcast in 2020, John McAfee said the same thing and committed suicide a month later. So look what happens. so that's, I want to get to the crypto part, but I think that, Cal, was that an okay summary from the banking side? Like, do you feel like it was, layman enough to understand?
Yeah, can I throw in a few questions just before you
Yeah.
get to the crypto? And these are like very basic questions.
Perfect.
Not even about banking. My first one is just about speed. We're at a place now, it seems to me, where when you think of bank runs, you think back to It's a Wonderful Life and Jimmy Stewart and all the people lined up outside of his
Yeah.
little office, and he knows we got to get to 5 o'clock. If we can stay in business till 5 o'clock. So every conversation he has with somebody, every hug he gives somebody, every argument he gets into somebody, the clock is ticking. Now it seems with the speed, you just pick up your phone, and I don't know how it's done, but basically everybody can just try and move their money out of the bank in an hour.
Yeah.
How could a bank possibly survive that? And especially if, just say there was nothing wrong, but somebody put out a rumor over the internet. Everybody got scared and just went to their phone and took their money out.
Great question, which is what the Federal Reserve is fighting, exactly that psychology, the rumor slash 10 seconds later, there's a run. Because that kind of is what happened with Silicon Valley Bank.
Yeah, it's a great point in that the speed of bank runs are now unprecedented, and unless we have artificial constraints, they're only going to get faster and faster because systems get better, right? Like the Federal Reserve is finally going live with a pseudo real-time payment system called FedNow, which it's going to have all sorts of restrictions in place in the beginning, but eventually the idea is that 24/7, even nights and weekends, you can move up to a certain amount out of any bank and into any other bank. So, Cal, us crypto people are actually fine with this because everything in the crypto world, in the crypto financial system, is instant 24/7 anyway. So, in crypto, there is this general understanding that you need to build systems that are resilient to the speed of the internet. And it looks like the traditional banking system is now learning the same lesson in the hard way.
I mean, and just to add to that, decentralized finance as opposed to centralized banks. So a bank is one company. The bank's management decides where all the money goes, and the bank's depositors don't see where that money goes. And on a daily basis, they have no understanding of what's inside the bank. With a decentralized crypto-based exchange like Uniswap, not Coinbase, which is centralized, but Uniswap is an example of a decentralized crypto exchange. The depositors, i.e., people trading on Uniswap, they see everything that's happening. It's full transparency combined with privacy, so you kind of know what's happening, and you're not very worried because of that. That's the goal of crypto.
Right. And not just the depositors, everyone. Like you and I right now could pull up one of thousands of websites and look at not just decentralized exchanges like Uniswap, but also decentralized banks like Aave or MakerDAO. And remarkably, we will know more about their balance sheet to the second than Jerome Powell knows about the balance sheet of JP Morgan. Or hell, even Jamie Dimon knows about the balance sheet of JP Morgan. Anyone who's worked in big banks knows that there is so much opacity throughout the entire system, even for the people who work there, which in a crisis, opacity is the most dangerous thing because the depositors who are fleeing will assume the worst.
Don't forget, Satoshi Nakamoto, the supposed creator of Bitcoin, made Bitcoin in 2009 as a reaction to the banking crisis. The original idea and concept of Bitcoin was to not have a crisis like the 2008 banking crisis. Now, there are thousands of more use cases of crypto than Satoshi's original outline, but that was the reason Bitcoin was created. It was totally a response to a situation like this. Just like the original intention of the internet was to send email. And now you could do many other things, like there's the web and there's websites and all these other things. But the crypto has evolved also. But this was the original purpose, was to avoid a situation like this.
Yes.
How does somebody who has a limited education in banking know what is a good bank to bank in? Because I can tell you, when you walked into a First Republic Bank in Beverly Hills, you were treated with a level of courtesy and, like, I'd almost use the word elegance. There's no lines. You went to an individual who was sitting down at a nice desk, and you were basically treated to figure out your situation. You knew the people at your bank. That would have been the last bank that I would have thought was going to have trouble because of the level of detail that they put into just interacting with the customer. But here I'm finding out that I had no idea what's going on behind the scenes.
To your point, this is why I think it's not the depositor's fault, is that depositors shouldn't be required to be banking experts to know where the risks are and where they aren't. Furthermore, even the bank experts, to Omid's point, don't know where the risks are and where they aren't. And it's almost arbitrary because at the current moment, every single bank is essentially bankrupt if there was a run on the banks because of the sharp increase in interest rates. So there's no way to know. But Omid, if you want to add to that.
No, I would just add that we as a society, Cal, made a decision at some point a long time ago that depositors should not have to shop around based on the safety of a bank. And this is ultimately a political decision and a social decision, right? It's not really a financial decision. But when we started introducing things like FDIC insurance, strict regulations, and then started bailing out depositors as we did during the savings and loan crisis, and then again in 2008, the consensus among society was that don't worry about it. Like you pick your banks based on the services they offer, the fees that they charge, convenience or costs, but not safety. And there are obvious downsides to this. The simplest one being the moral hazard argument that, well, if depositors don't care how safe their banks are, you're going to end up net with more dangerous banks because it's not something they're competing on. The political answer has been, yeah, depositors will not worry about it because regulators are going to worry about it. The regulators will pass rules that make sure that banks behave responsibly. But what we see with every passing crisis is that regulators are always caught flat footed and are always fighting the last war. So our banking system today is extremely resilient against the problems that took down everything in 2008, but turns out it was not resilient against the simple issue of interest rates going up and duration mismatch. So now I'm sure we get new rules and regulations that say, well, we're going to prevent that from being a cause of a crisis the next time around. But that likely just means that we're going to be completely blindsided when the next crisis comes.
This is such a valuable service for all business owners, big businesses, small businesses, doesn't matter. I wish I had this in the many different businesses that I've started. Sometimes it seems like your business is humming, but then suddenly you don't understand it. You're starting to fall behind. You're not understanding where your costs are, where your revenues are, where your payments are. Teams are buried in all sorts of like BS work, and you can't seem to close the books. So you need like one dashboard, one source of truth. I'm jealous of this business, NetSuite from Oracle, of course, NetSuite by Oracle. I wish I'd come up with this idea. It's a brilliant concept to have all your business intelligence on one dashboard. This is why you need to know these three numbers: 37,000, 25, and 1. So 37,000, that's the number of businesses which have upgraded to NetSuite by Oracle. NetSuite is the number one cloud financial system, streamlining accounting, financial management, inventory, HR, and more. 25. NetSuite turns 25 this year. That's 25 years of helping businesses do more with less, close their books in days, not weeks, and drive down costs. One, because your business is one of a kind. So you get a customized solution for all of your key performance indicators, your KPIs, in one efficient system with one source of truth. Manage risk, get reliable forecasts, and improve margins. Everything you need to grow all in one place. So right now, download NetSuite's popular KPI checklist designed to give you consistently excellent performance absolutely free at netsuite.com/James. That's netsuite.com/James to get your own KPI checklist. netsuite.com/James. The future of learning is definitely online. Like, it's such BS that you have to spend $200,000 or take $200,000 in loans and go to some fancy school when it's useless. It doesn't guarantee you a job. Most employers, including me, do not care about degrees or grades or anything like that.
We want to care that you love what you're doing, that you know what you're doing, in some cases that you have experience or that you're willing to learn. But people in general love learning and are curious. Like the key to success is curiosity. And I think masterclass.com is the perfect model for online learning. I'm really happy they're sponsoring this episode. If you're going to give a gift, give the gift of learning. Masterclass makes a meaningful gift this season for you and anyone on your list because both of you can learn from the best to become your best, from leadership to effective communication to cooking. Let me tell you some of the classes I've taken. I've taken comedy from Steve Martin. I mean, can you believe I can take a class from Steve Martin on comedy, or Judd Apatow, my favorite comedy director? I could take an actual class from him on writing. Wolfgang Puck on cooking. Dan Brown on writing, or Judy Bloom, who's been on this podcast, on writing. By the way, Wolfgang Puck also has been on this podcast. It's such a pleasure. I try to take classes all the time from masterclass.com. And whether you're watching Masterclass on TV or listening in audio mode in the app or on their site, the quality speaks for itself. It's like these masterclass instructors are your own personal mentors that are going to help you reach the next level. How much would it cost to take one-on-one classes on comedy from Steve Martin or on chess from Gary Kasparov? You just wouldn't be able to do it. But it would cost hundreds of thousands of dollars. With a masterclass annual membership, it's $10 a month. Memberships start at $120 a year for unlimited access to one-on-one classes with all 180 plus masterclass instructors. So it's not just $120 for one instructor. You get all 180 plus masterclass instructors. Boost your confidence and find practical takeaways you can apply to your life and at work. And if you own a business or are a team leader, use Masterclass to empower and create future-ready employees and leaders. That's the real education in today's world. So this holiday season, you can give one annual membership and get one free at masterclass.com/JAS. JAS, of course, stands for the James Altucher Show. So right now you can get two memberships for the price of one at masterclass.com/JAS. Masterclass.com/JAS. Offer terms apply. Every time interest rates rise quickly, banks fail. I mean, even the Great Depression, 1933, like all the banks failed. There was a bank holiday. President Roosevelt, when he became president, had to shut down all the banks. And there was rumors that he was shutting down all the banks, which made the run more intense, which meant they had to shut down the banks even faster. So like we've seen the story play out and it turned into the Great Depression. And each time I feel we learn a little bit more, but Omid, to your earlier point, because we learn a little bit more and we learn the easy money solves the problem, we just keep on printing easier money.
And here's where I think crypto is actually very useful as an alternative that we can consider. Because Cal, let me ask you, why did you have an account at First Republic? What were you doing there, if you don't mind sharing with us?
Actually, because I moved to California and I started to have breakfast with Larry King every day, and he used First Republic Bank. And I saw, look, when Larry walked in, he got very special treatment. And so I was next to him. So I don't know if I got more special treatment than anybody else, but I do know that anybody who walked in that bank got to see a personal banker and get individual service. They knew each other by name. And I really didn't see that anywhere else.
I've used Signature Bank for 15 years for the same reason. It's just the personal service that you got was better than what you would get at one of the big banks. But what I meant was, if you don't mind telling us, like, what were you doing there? Did you have a savings account, a checking account? Were you using a credit card? What services were you getting from that bank?
Yeah, I think it was a basic checking account that has been, because I now live on the other side of the country and there are no First Republic banks near me. It sort of has become meaningless in that I don't know the banker to go to. So it was just a part of the timing of my life that led me there. And it was actually, it made banking a beautiful experience, which is why when I am seeing this, I'm feeling horrified because if any place seemed to be doing it right, it was First Republic Bank. And I'm just wondering how they could be in this mess.
So let's talk about the architecture of banking then, because you mentioned having a checking account, right? Like and your checking account didn't pay any interest anyway, I assume, right?
Right.
Yeah, right. So you just needed a place to park money because you had to pay your bills.
Correct.
And one of the current design decisions of our banking system is that people like you are effectively forced to subsidize people who need mortgages or want a credit card. By which I mean, you just need transaction servicing. You need in the old days, you'd use cash, but cash is going away. So now you got to pay rent and you use bill pay and whatnot. So you park your money in a bank, but then the bank turns around and takes a portion of that money, or it's fractional reserve banking, and they give someone a mortgage or a credit card or a construction loan, or ultimately, they fund the US government too by buying treasuries. And that's one design of a banking system, but it's a very fragile design of a banking system because it lends itself to the exact situation that we're in now, where you have a lot of asset liability mismatch on part of the banks. A different design of the banking system is, imagine where there was a bank that allowed you to you just wanted a checking account. They would give you a checking account, and all they ever did with your money is buy 30-day US treasuries, right? Bonds that just are extremely short term. They're basically cash in the financial system. And a lot of the problems that have happened in the last year where interest rates went up, so bond values went down, that's for like 10-year bonds. So it doesn't apply to 30-year bonds, right? That kind of a bank, which in traditional economic parlance, people call a full reserve bank or a narrow bank. It's also possible that it wouldn't even buy treasuries. It would just park the money at the Fed. All American banks keep some of their money at the Fed. There's a design where you say, no, this bank exists for no other reason than to take Cal's money and park it at the Fed. And then if Cal needs to pay James, then who cares? It's just a debit and credit on its systems. Ironically, in our current system, the government has not allowed that kind of narrow or full reserve banking to exist because they say, well, if you open a bank like that, it's so much safer than a First Republic. Me, James, and Cal put most of our money there. And now the banks that are doing mortgage lending and construction lending, they have to pay higher interest and they're going to have to charge the borrowers more.
Wow. Okay, now this is why I'm walking into a bank, and for me, the experience was personal. And not only that, but when you know who you're dealing with, you don't have to pull out your driver's license and go through this rigmarole of being checked. They know who you are. So I wasn't looking behind the curtain, see what the Wizard of Oz was doing there. And I wasn't thinking of it that way. I was thinking, okay, how does this benefit Cal right now? And it made me comfortable and it did what it was supposed to do.
Yeah, and it's not like the Wizard of Oz here is doing something bad. The banks are the source of everyone in the country buying homes because most people get mortgages. The banks are the source of loans for many small businesses who need to survive and grow and flourish. And that's why the US economy is so innovative compared to almost every other economy in the world. Like, as a culture or a society, we made this decision hundreds of years ago for a reason. This is the best, most effective way to grow an economy, it turns out.
Well, a debt fueled economy, James. I'm going to disagree with you a little bit in that what we're doing in this situation is we're forcing the Cals of the world who just want to park their money and make payments to subsidize people who want to buy a house or take out a small business loan. And that is ultimately a political decision. The benefit of it during the good times is we get cheaper financing across the board. So you do get more home ownership and more investment. The downside of it is that it is a more fragile banking system by design. It's going to be prone to more crises like the one we're experiencing today.
Yeah, I agree. There's a give and take. You're paying for that innovation.
Okay, I have a third question and then I'll let you move it along to the crypto. And I hesitate to ask this question because it's a terrible, terrible terrible scenario. But I'm reminded of a time where I was on like an internet conversation like this, and a world-renowned expert was talking about politics, and it was in the run-up to the Trump-Biden election. And I wanted to ask the question, like, what if Donald Trump doesn't want to leave office, or his supporters want to stop the rightful president from assuming the office? And the way the guest was talking was like, well, that can never happen. It's impossible. And then I'm watching on January 6th, and everything that I was thinking in my head was being sort of played out. And so my question now is, what is it? The end of, or sometime June or July, the government runs out of money, and Congress needs to do something to basically say, okay, you can borrow more and keep the thing rolling, which seems like we've been doing for a long time. What if that happened like on the same day that banks were getting run at? And you've got a Congress now that's pretty well split, and there are people who don't want to bail out anything and just say they don't go along with it. What happens then?
I mean, that's a good question because it's never happened. I mean, every year this happens where there's a budget crisis. We hit the debt ceiling and Congress has to vote to increase it. And the newspapers always say, oh no, hundreds of thousands of government employees are not going to get their paycheck. It's all over. Every year this happens. And the same thing happens, which is that they raise the debt ceiling and there's never really an issue. So I would presume that Congress wouldn't be so split as to not come to some agreement and raise the debt ceiling again, because that's just what always happened. But yeah, it's possible that that could fail. That's also built into the system, that we're going to basically come close to failure every year, but we're going to compromise and agree to move forward. But what if we don't? That's a good question. It could theoretically happen. By the way, your friend about the presidential elections is completely wrong. If he just looked at history, 1824, the presidential election of John Quincy Adams versus Andrew Jackson, there was also some third parties. Andrew Jackson won by a huge amount, the popular vote and the electoral college. John Quincy Adams lost both, but neither side got 50%, so it went into the House. And John Quincy Adams pulled aside the Speaker of the House, Henry Clay, and said, listen, I'll make you Secretary of State if you make me president. Deal done. And so John Quincy Adams became president despite clearly losing, it wasn't close, the Electoral College and the popular vote. So there was a rigged election more than once. 1876 was another example.
All right, I got to do some homework here, but it sounds like everybody that I talk to in finance, they always say, don't worry, at the last minute, it's always going to be resolved. And it just seems to me that you've got some people sitting there now that don't want this resolved, that are saying, no, we are not borrowing any more money. I don't know if that's happened in history. Maybe you can enlighten me there.
It always happens that people posture in order to get what they want out of the compromise. But you're right, though. The real answer is we just don't know what would happen in that case.
All right, I'll let you move it on.
I'll add one thing, that we were talking about inflation earlier, and James was quoting what Milton Friedman said, that it's always a monetary phenomenon. But I think it's really a trust phenomenon. Like, inflation in a currency is highly tied to not just how much people trust that currency, or that the supply of that currency will not be hyperinflated, but what is the political and legal system underlying that currency, right? Like, one of the reasons the dollar has been the global reserve currency for decades now is that people trust our political and legal system far more than they would a Venezuelan one or even a Chinese one. But everything that's happening today, from the dysfunction in Washington to the actions that the Federal Reserve is taking, to me, is starting to undermine that trust. And the net result of that trust is going to be more inflation than we would like.
Look at a very stark example. China just brokered relations between Iran and Saudi Arabia. The head of China, is in Russia now for a 3-day visit. Uh, the world is is shaping up without us a little bit for the first time in 100 years, and that is a potentially scary thing for the dollar because, so as Omar just mentioned, so much of the world uses the dollar as its currency. But if Iran, Saudi Arabia, Russia, and China decide that, hey, we're going to start trading oil in yuan because the U.S. hasn't been good to us lately, that's an issue for our dollar, and quite deservedly. Like, we're all about justice and liberty for all, but who have around the world have we really given justice and liberty to in the past 20, 30, 40 years? And I think these could be real issues that, combined with the domestic issues, could have a problem. And I'm not being a doomsayer, I'm not being a conspiratorial. These are just things that are happening that people have to think about.
And James, that is such a good point because I fear that the headlines about the Iran and Saudi Arabia warming of relations or China and Russia getting closer have sort of been lost in the current banking crisis. But
Yeah.
I've been monitoring it very closely because, full disclosure, as a crypto person, I feel like, one reason why I'm generally bullish crypto is that it's ever more useful in a multipolar world where the dollar is losing its status. One of the anchors of the dollar's status as a reserve currency has been the petrodollar system. Right? Just to oversimplify for your audience, this idea that, the US brokered these deals decades ago where the world's biggest oil producers like Saudi Arabia price their oil in dollars and they get paid in dollars. And that forces the world's biggest buyers of oil, like China, to always have to need to buy dollars because that's how they pay Saudi Arabia. And this arrangement has really benefited America and thus Americans. It's kept our inflation low and it's kept demand for US treasuries high. So, literally, like, more Americans were able to afford houses because of this arrangement. And there are all these shifting dynamics globally that, it starts with like the US sort of pulling back militarily. Then there's the fact that we have weaponized our sanctions regime to the point where, given what we did to Russia and before that Afghanistan, if you're the government of any country that relies heavily on dollars, you might be thinking about diversifying. And then lastly, the fact that previous enemies like Iran and Saudi Arabia are starting to talk. I don't want to get too far ahead. There's still many significant differences between them, but there is a world in which Iran, Saudi Arabia, Russia, China, India, the UAE get together and decide that, what, we're overly dependent on dollars, right? Like Saudi Arabia is selling a lot of oil to China. Why is the US getting to have power over this with the currency that they use? So if these countries start to move away from the petrodollar system, it's going to have significant implications on inflation, US power, and ultimately crypto.
And now, Omid, let me ask you, did they target Silicon Valley Bank and Signature because of crypto?
So they targeted Silvergate and Signature because of crypto. And if you don't mind, I just want to spend a couple of minutes talking about this because I think this is important for the audience to know, and this should be a scandal.
Yeah.
So we all know that crypto is very volatile. We talked earlier that it's bad for any bank to have concentrated deposits. Unfortunately, the crypto industry in some ways had the most concentrated deposits. They were literally mostly at two banks, Silvergate and Signature, but not necessarily by choice, because US bank regulators have always frowned upon crypto in a way that the big banks just refuse to bank crypto companies. They're coming around a little bit now that it's going more mainstream, but every crypto company could tell you that for years, if you went to a Bank of America, JP Morgan, and said, hey, I'm a Coinbase. I want to bank through you guys. They would say, no, it's too risky. Our regulators have not given us clarity. We don't want to deal with it. That created an opening for smaller regional banks. And importantly, Silvergate and Signature both had real-time 24/7 payment systems among their clients. A lot of people might be surprised that if you have an account at most banks and you want to pay somebody else who has an account at the same bank, they often can't process that payment in real time. But
Right.
crypto,
If you do it at like 6 p.m., it shows up the next morning at 9 a.m.
right.
It's not instant.
It's not instant, just mostly because the infrastructure is old in banking. But because the crypto markets are 24/7 and Bitcoin, for example, trades 24/7, if you're an exchange, a lender, a hedge fund, a wallet provider, you want your banking to also be 24/7. So Silvergate and Signature attracted significant deposits because A, they were willing to take crypto companies as clients, and B, they had 24/7 payments among them. So they were very important infrastructure for the industry. But given the bear market of last year, the collapse, the delevering, the fraud of FTX being exposed, they, first of all, they experienced significant declines in their deposits because their customers were blowing up. And we talked earlier that that's not good for a bank. But the other thing is they came under significant political scrutiny. And there has been an amazing series of events just in the last 3 months that within the crypto industry we call Operation Choke Point 2.0. This is a reference to something the Justice Department did, I believe, under the Obama administration, where they tried to hamper legal industries like online poker by preventing them from getting access to the banking system. And the TLDR of what happened is that first, all of the federal banking regulators put out a joint memo in January that effectively said they think crypto is dangerous for banks. There was this one remarkable memo in it that said, we're not here to tell banks what industries they can or cannot serve, but we don't think there's any safe way to serve crypto. Ask anybody who's worked in banking, that kind of statement from your regulator is almost as good as them telling you not to serve a particular industry. And I think this is a remarkable document, this public memo that people can Google and read, because if there's one rule every bank regulator should follow, it's first do no harm, right? Like there's a reason why President Biden and Janet Yellen and Jerome Powell have repeatedly said in the last week that they believe our banking system is safe. Because the second anyone in power says any banking system or banking activity is unsafe, you have sown the seeds of doubt and you might trigger a run. So I think it's remarkable that although crypto is a very small industry, you had all the federal bank regulators say, hey, we think crypto banking is dangerous. Because think about the message that's sent to the depositors of Silvergate Bank or Signature Bank, and potentially even SVB, even though it did not have a significant crypto clientele. So Silvergate ended up shutting down a couple of weeks ago. There was a few other questionable things there, like the fact that it was under constant attack from Elizabeth Warren in the Senate for potentially being involved in the fraud that FTX committed. But again, think about this. You have a sitting senator questioning the viability of a bank. What message was she sending to the depositors of that bank? Not a good one. Right? And then the last piece is that it had gotten emergency funding from an arm of the US government called the Federal Home Loan Bank System, which there are questions as to why they chose to repay that loan in a way that would lead to their demise. Were they forced to? Did they decide to? We don't know the answers. But what ended up happening is that because of Choke Point 2.0 and the multivariate situation with the treasury market, shrinking deposits, etc., Silvergate Bank shuts its doors. Within a couple of days, the run on Silicon Valley Bank begins. And I believe the fact that one tech-friendly bank in California failed surely registered in the decision-making of the customers of another tech-friendly bank, which is Silicon Valley Bank. Maybe they all would have failed eventually anyway because of this dynamic with the bond market. But certainly the fact that the US government drove one bank to the brink did not help the cause. And then a few days after Silicon Valley Bank fails, at the same time that the Federal Reserve last Sunday announced a special bailout, the one that you described where I said they did it, but they didn't do the part where they got shareholders, the government announced that. But simultaneously, they announced that Signature Bank in New York was shut down. And it was shut down by the New York State banking regulator. And there are a lot of open questions about why that happened because people who work there, including Barney Frank of the Dodd-Frank legislature fame, who happened to be on the board of it, has come out and said that Signature was shut down even though it wasn't insolvent because it was a crypto bank. And there's been other red flags that have come out since. But when you zoom out, there's clear evidence that the US government went out of its way to drive crypto out of the US banking system. But one of the unintended consequences of those actions was a generalized bank run that's now ended up consuming banks like First Republic that had nothing to do with crypto.
Yeah, and so where can you bank crypto?
It's extremely difficult in the US today. There are some other small and regional banks that were starting to lean in. However, who knows what decisions they've made just in the past week, given the overall environment.
What about Coinbase? Is that, that's almost equivalent to banking. Is it safe there? Which is the biggest crypto exchange.
It's more a question of like, where is Coinbase banking? And from my contacts throughout the industry, I know that everybody's been scrambling to open up as many bank accounts as they can. The crypto industry also learned an important lesson in recent months that they don't want to be they don't want to have all their money in just one or two banks. Unfortunately, unless something changes in the US as far as federal policy is concerned, everybody's looking offshore now. That people are looking for banking relationships outside the US where they don't necessarily have these problems.
But then the question, asks itself, Omid, in order for Bitcoin, say hypothetically, to get to $1 million, a lot of people have to buy it. There can't just be like billionaires buying it. A lot of people have to say, oh, I need some Bitcoin to protect myself against diversify against the collapse of the dollar. And grandma and grandpa in Indiana are not going to say, oh, well, I need to spread my money out to 16 banks and I'm going to use a MetaMask wallet here and a Treasure nano storage here and remember my 24 key password in like 3 different places and hiding spots in my house. And they're just not going to do it.
No.
And so this is going to dampen a sharp increase in crypto as much as it deserves to be much higher because of ultimately the story it tells and the solutions it has. But just how do people buy it and store it? It's hard.
It is hard. The liquidity thing is actually interesting because in the short term, you can argue it both ways. Like there is less liquidity in the crypto markets now because the US based entities have less access to banking. But to me, that just means more volatility. And it could mean more volatility to the upside because if suddenly the price of Bitcoin starts spiking, some of the traders and hedge funds and market makers who would be there to short it aren't there anymore because they don't have a bank account. But in the long run, it's important to remember crypto is a global phenomenon, James. And at the same time that the US has gone out of its way to debank crypto, the rest of the world, from a regulatory perspective, is becoming more and more friendly towards crypto literally by the day. And in the US, it's actually not just the debanking thing. It's also like the SEC has gone out of its way to hold back crypto companies. Other state and federal regulators have been coming down hard. At the same time, the UK and the EU are increasingly pro-crypto. The Middle East, Singapore, Hong Kong just made this radical shift from being starkly anti-crypto in the same way that China was to just literally normalizing it. So at the end of the day, like people say this about the internet, right? If for some reason the US government had decided to crack down on the internet 25 years ago, that doesn't mean that there wouldn't have been a Google or a YouTube or a Facebook. It just means that those would have been non-American companies. And unfortunately, crypto is now headed in that direction.
Well, I mean, the US was initially worried in the mid 90s about, hey, are all the phone companies going to go out of business? You know, because everybody's going to make phone calls over this new thing called the web. And people would tell me with confidence, oh, the government will never let the internet expand because there's crime on the internet and the phone companies will go out of business. So the US will protect those. But, ultimately,
That's funny. I
you
didn't
know,
know that because people have been saying that to me about crypto for years, that like the
it,
US government will not let the banks get disintermediate. They're going to like kill Bitcoin when it gets that big and so on.
I mean, the banks are probably more powerful than the phone companies, but maybe not. I mean, AT&T and Verizon were, pretty big, and all the phone companies were pretty big companies, and the cable companies and so on. And people like high level executives then were telling me this will never happen, and there was just nothing they could do about it. And so, I think crypto is sort of where the internet was. Like a few years ago, crypto was where the internet was in 1995. Now it's where the internet was in 1998 or 1999, meaning everyone knows what it is, but it's very hard to use, and there aren't enough users yet. So the promise is there, the potential is there, but it wasn't until 2005 that people said, "Oh yeah, I'll put my credit card in the internet." It wasn't until 2005 there was a billion users. It wasn't until 2005 websites were easy to build with companies like WordPress and Squarespace. You didn't have to know how to be a programmer to make a website. So we're kind of following the same evolution, hopefully faster.
Yeah, and actually, I have a question for you, James, because one of the interesting things with new technologies is I think they change the power dynamics among industries. So, to give you a specific example, to me, crypto really threatens the big, too big to fail banks. At the end of the day, like my opinion of JP Morgan today is that JP Morgan is the poor man's Ethereum. That in time, Ethereum will do what JP Morgan does in terms of allowing people to send money and other assets around the world, faster, cheaper, and safer. Um, Interestingly enough, though, crypto elevates the importance of the asset management industry because one, we have a new asset class that doesn't happen often, and two, all of those tokenized forms of money or securities or whatever that are now writing Ethereum, they're going to need servicing, they're going to need custodians, they're going to need issuers, and one thing that's really been interesting to me is that as much as the big banks have been poo-pooing crypto whenever they can, if you look at the asset management industry like BlackRock, Franklin Templeton, Fidelity just turned on the ability for millions of its retail customers to be able to buy and hold Bitcoin through them. And this might be how the political issue gets resolved, that for every banker that says, hey, this is bad for me, you have a asset manager who says, well, too bad, it's good for me. What was the internet version of this? Like AT&T, Verizon, yeah, they saw a decentralized network for communication as bad, but what industries showed up at that moment to tell the government that it would be good for them?
The communications industry. So the irony is if you can't beat them, join them. So the cable companies built, high speed fiber optics to Europe and turned on the internet and bought internet companies and ISPs and provided internet through the cable lines. And these communication companies are 100% internet companies now. So to your point, like to our earlier point, crypto is hard. Like it's hard to buy, it's hard to store, it's hard to understand, it's hard to transfer. So banks are good at all these things. And to Cal's point, it's courteous. The banking industry is courteous. You cannot get customer service at any crypto company. Who is going to call a company called Sushi Swap and find customer service there? Like you can't. So
That's a trick
ultimately,
question. It's not even a company, and there's
right? It's
no
not even a
phone
company.
number to call.
Right. There is no customer service. So ultimately, crypto needs a front end, a
Totally.
financial front end before there's going to be before there's going to be a billion users. There has to be a billion users, just like for the internet. And the banks are the only ones well positioned to provide that front end. and nobody else is going to do it. And so I think ultimately you see this in Jamie Dimon's statements. At first, he was only saying crypto's a fraud. Then he was like, okay, crypto's a fraud, but we're going to build a crypto department. And then he was saying, oh no, crypto, I never said crypto was a fraud. Now he's saying maybe it's a fraud. I don't really know yet. But
No, he's still saying it's a fraud, even though JP Morgan now literally offers Bitcoin products to its customers. So you have a lot more reach than I do. I would love, like, the next time he's on CNBC or somewhere, someone asks him, like, so just to be clear, your private bank is now selling a fraud to its customers.
Right. Well, I should have asked that to different bank people I've had on, but I do think we're going to go down the trend. If we truly are where the internet was in like 1998, 99, eventually it's going to be, if we can't beat them, join them. And that's what's going to happen. Because look, London, which has a super crypto friendly prime minister now, is, and the UAE, those two areas, UAE and London, are competing to be the crypto banking centers of the world. And people like Jamie Dimon are not going to let that happen.
Actually, to your point, I do agree that banks are still going to be important. It's just a question of which banks. And to your point, European and Asian banks have been much more forward on crypto adoption than American banks.
Yeah, and now the SEC chairman, he's like going crazy or something about crypto. Like he doesn't even make sense in what he's doing. And even other SEC commissioners are writing, statements against what he's doing. So there's going to be, let's say, there's the boomers, there's the Gen Xers, and then there's what followed. Okay, the Gen Xers are debating the fraud, not fraud issue. The boomers are all about gold, and the Gen Y and Gen Z people don't even know what gold is. So at some point, people are going to get old, they're going to retire, and it's already getting there. The Elizabeth Warrens of the world are going to leave office, and people who only know crypto and the internet are going to take over, and that's going to happen fairly soon.
From your mouth to, I don't know, Joe Biden's ears.
Satoshi's ears.
Right.
Yeah. Well, is there going to be a banking collapse, Omid?
No, but actually, the reason I came on, if you remember, was because of the prediction I made the last time on your podcast that we were talking about FTX, and I predicted that soon enough some crisis or scandal would come out of the traditional system that would make everybody forget about FTX. So not that I want there to be crisis, but I do want to take a victory lap here. However, I don't think we've seen it yet. I think the banking crisis is the canary in the coal mine. I think the real crisis and scandal that'll come out sometime this year probably is buried somewhere deep in the bond market, because we just had one of the most historic bull markets ever in anything in the bond market, and it ended in spectacular fashion with the Fed hikes. And you, James, and Cal too, probably, as a student of human nature and markets, could appreciate the fact that anytime there is a very, very long lasting bull market in anything, first there's a crisis and then there's a scandal. And by scandal, I mean like FTX or Bernie Madoff or WorldCom. So I still believe that both of these things will come out of the bond market. They will be aided by the fact that compared to banking, the bond market is even more opaque. And when that does happen, it will really highlight the full transparency of crypto and decentralized finance.
Yeah, and I have one point and one question, which is, first off, how do you buy a bond? I can't just go on an exchange and buy a bond. Like to this day, actually, I've even been a hedge fund manager, as you know. I mean, we work together on a hedge fund. I don't even know how to buy a bond right now. You have to call a broker at a bond brokerage or something. It's not easy to buy bonds.
No, the market is significantly more fragmented than the equity market. A lot of people buy bonds through things like ETFs just because it makes
closed-end fund, you can buy bonds. That's it. I know how to buy bonds through the stock market, but not like, oh, I want to buy this loan that everybody made for David Bowie's music. I can't buy one of the Bowie bonds. But the other thing is, though, but what form do you see this crisis happening in the bond market?
I don't know. I'm actually not smart enough about the bond market to know exactly. I just know that for our lifetimes, interest rates have not gone up until a year ago. Like there's been this trend that really began with when Paul Volcker in the late 70s, early 80s decided to rein in inflation by jacking interest rates to the moon. And we've had this long-term global decline in interest rates, which anybody remembers their high school econ class, when interest rates go down, bond values go up. And every time it looked like rates might go up for any reason, the government has intervened, right? So not only is this like a 40-year bull market, but it's a 40-year bull market that was effectively subsidized by trillions of dollars and euros and yen in printing. So there's a generation of people who've never been taught a hard lesson in the bond market. And you study human nature, you know that that sort of thing ends with scandal.
I wonder if we could see it happen in the insurance industry, if there's large disasters where trillions of dollars worth of people need to be paid off somehow, and then we see really the exposure of the insurance companies to the bond market, and they just can't pay. You know, like almost happened with AIG in 2008, and these insurance companies just can't pay what they owe.
Possibly, or the leverage loan market, leverage buyouts, private equity. I mean, one of the things about the bond market is because it's generally perceived to be safer than things like equities, you tend to have a lot more leverage from it by everyone. We saw some hints of this, by the way, like when in the UK, pensions had to start dumping their UK bonds because of issues having to do with interest rates were too low for too long, and they bought these instruments that juiced their yield, but it meant that when you had spiking rates like the Bank of England was orchestrating, they would have to start dumping UK bonds. So again, I am not smart enough about most things, including the bond market, to tell you exactly where the bodies are buried, but it's a multi-hundred-trillion-dollar asset class that's only gone in one direction for a very long time. That sort of thing never ends without a scandal and a crisis.
And we'll see. Maybe the Fed, though, knowing this is on the horizon, maybe they'll somehow figure out how to reverse and save face at the same time.
Oh, I'm sure it's going to warrant not just the Fed, but other central banks to intervene. But then that means they're giving up the fight on inflation. And it means we're going to have just persistently high inflation indefinitely, which this is not investment advice, but that's the kind of thing that makes certain kinds of people want to own crypto.
But I will say this also, and I'm of course a big believer in crypto, but owning anything that is priced in dollars is good. Like not just crypto. Now crypto's made for this on the banking sense, but owning stocks that are priced in dollars, they'll go up too if the dollar weakens. Or owning real estate potentially. I mean, they're more affected by interest rates, but owning real
Right.
estate in the long run will go up if it's priced in dollars. Collectibles will go up if they're priced in dollars. So stocks, anything priced in dollars that aren't dollars will go up. But it's just that crypto, for a store of value, crypto was made for this.
I agree, but the thing to remember is that things like stocks are more complex. Like companies, if inflation forces companies to make less money and it impacts earnings, that's not great for stocks. And some, you would know better than me, but some amount of the stock market gains of recent decades has been because of debt fueled share buybacks.
Almost all of
Um,
it, actually.
okay, well, there's that. And then real estate is the most levered industry. So persistently high interest rates, if we get them, are going to be a problem. Plus, the one good thing about crypto is it collapsed already in the past year. One of the nice things about crypto, once you get to the other side, is that we don't have bailouts and we let things blow up. And we have mass delevering events like we already did last year that lead to prices coming from significant lows in a way that real estate hasn't fallen that much, stocks haven't fallen that much, even collectibles
Yeah,
haven't fallen that much.
yeah. So, Cal, any last minute thoughts, questions, concerns, fears, hopes, happiness?
Well, I'm hopeful that we get to a place where, and I start with myself, I got to get more educated about this. I'm listening to all this and I'm just realizing that this stuff is behind a wall that I've never peeked into. And it really is time for me to understand what's happening when I go into a bank and I start an account there. And so, one of the beauties of this conversation for me, even though you probably didn't intend it uh, this way, you're trying to show people what's going on and where things are going, is I completely understand that I got to go back to basics here and understand how this was put together so I can fully appreciate more of these conversations.
Well, that might be true, but I also wouldn't educate too much on it because for every point that both Omen and I were making, there was a point in history before that that led to the point we were making. So you can go back to, like, take student loan debt. Student loan debt's this huge problem in the U.S., but it can be traced back to, you know, the Johnson's Great Society program, where formations of companies like Sally Mae to back student loans, but that could be traced back to you know traced back to the Veterans Bill in 1946, which paid for veterans student loan debt, and it could go on and on. The over marketing of colleges in the 70s, everything we're saying, like for instance, the banking crisis of 2008 could be traced back to subprime loans being created in the late 90s, could be traced back to also the Great Society program and welfare programs and housing projects and so on, which could be traced back to and on forever. So the problem with learning about all this stuff is that there's no end to the things. It's fascinating and it's interesting and it could give us all educated guesses, but the true answer really for all of these things is we don't really know. We're just trying to make as well educated guesses as possible. And but our point is that just like we don't know, Jerome Powell doesn't know either, and like that.
The one thing I do know is Cal should read my book.
What's the title?
All right,
Both of
you got it. That's where I'll start.
Email me your address, the new one, because actually, James, I will take this moment to plug it. So much of my new book, Re-Architecting Trust, is not about crypto. Right? It's about why is the banking system the way it is? Why was central banking invented in the first place? Why does inflation happen? And then from there, it goes into how might crypto be an upgrade. So, Cal, please send me your address. It would be my pleasure to send you a copy. And then maybe we can all come back in some months and discuss what we've learned. And Cal could give me feedback other than what James has already told me, which is that the title sucks.
But that said, say the full title again because it's on Amazon. You could buy it. It's an excellent book. I think it's the replacement to, was it Peter Bernstein's book on risk? I think it's better than that in terms of understanding the financial system. So what's the title?
Thank you, James. It's Re-Architecting Trust, the Curse of History, and the Crypto Cure for Money, Markets, and Platforms.
That is a lot of words, brother.
And Cal, what's your latest book? What's your book of interviews?
We did Meaning of Life for the composite of the interviews I did for Esquire. There are 3 of them. And another one's called What I've Learned. And those are basically all interview based, the wisdom that people who've lived incredible lives, they've been icons of the last 75 years, the wisdom that they've taken from all their experiences. So I think it's time that we all pay attention to the dollars, and not only that, but all the things you've been talking out beyond that, because I've interviewed a lot of people about fears and trust and what they believed were the most important things to them. But at least for me in my life, I am seeing that I better start following the decimal points. So we'll look at today as a start of something great.
All right. Well, for both of you, thank you so much for coming on the podcast. And Omid, thanks for the crypto perspective. Once again, you're always a good crypto expert to follow and to ask questions to. And may the odds always be with you.
Thank you, James.
Thank you, James.
Honey, we've got carolers.
Oh, no, we're just here to spread joy through Jollytown.
Honey, they're selling timeshares.
No. Jollytown is in the Quick Trip app. Every order you make is a chance to win free coffee, donuts, taquitos.
Honey, they're selling taquitos.
No, those are things you could win, like a year of free drinks.
Honey, can we go to Jollytown?
Already placed an order.
Spreading joy one order at a time. Visit Jollytown in the QT app. QT. More than a gas station.
Entresto, sacubitril valsartan tablets, is the #1 heart failure brand prescribed by cardiologists and has helped over 1 million people with heart failure. It's a prescription medicine that treats adults with long-lasting chronic heart failure and works better when the heart cannot pump a normal amount of blood to the body.
Don't take Entresto if pregnant. It can cause harm or death to an unborn baby. Don't take Entresto with an ACE inhibitor or aliskiren, or if you've had angioedema with an ACE or ARB. Don't take with aliskiren or within 36 hours of taking an ACE inhibitor. The most serious side effects are angioedema, low blood pressure, kidney problems, or high blood potassium. Angioedema is swelling of your face, lips, tongue, and throat that may cause death. If it causes difficulty breathing, get emergency help.
Ask your doctor about Entresto. To learn more, visit support.entresto.com or call 833-446-6699. For pricing, visit Entresto.com/cost. If you can't afford your medication, Novartis may be able to help.